Welcome back to Switzer on Australia's Business Channel. Business confidence dipped in September, but you shouldn't wonder why, with a chorus of policy leaders doing their best to spook anyone brave or silly enough to invest in their business or hire a new employee. We know Treasurer Joye has been beating the budget deficit and debt drum since early March, and combined with the fiscal fight that followed budget night, consumer confidence collapsed and is only limping back. To make matters worse, one of the smart guys at the Reserve Bank, Guy Debelle, opted for the dumb idea to state the bleeding obvious that markets one day will have a violent market sell-off. Yep, that's what markets do. They go up by stairs and come down by elevators. But what were we supposed to do with that information, Guy? Sell all our stocks? Dump our bonds, sack workers and cut costs? Was he hoping businesses that already aren't borrowing enough to get our economy growing over 3% would wait longer to believe in our economic future? Thankfully, the Prime Minister got on the right song last week, talking up the importance of the coal industry. It does bring a lot of export income, hire workers, demand services and support regional areas. He also announced policies to encourage entrepreneurs and innovation, which includes tax incentives for employees in start-up businesses younger than 10 years and with a turnover under $50 million. This reversed a Labor government decision of 2009, which was anti-entrepreneur and anti-innovation. It's heartening that the opposition leader, Bill Shorten, says he wants to be business-friendly, but the proof will be in the pudding of policy he cooks up. Words are cheap, but they are and can be damaging. Words of warning come too easily from politicians, Treasury officials, Reserve Bank spokespeople, economists and media commentators. And while being realistic in one thing, being balanced is another. Right now there's a lot of better news on the economy, but it does not get the media cut through with Ebola, Europe slowdown, the Ukraine drama and ISIS concerns spooking everyone. On top of that, now we've had the overdue stock market correction to contend with, and this is going to make the task of talking up the positive in the economy even harder. That said, remember, our house prices are up 13.7%. Economists think unemployment might have peaked. Annual dwelling starts at a 19-year high. New car sales rose by 2.9% in September and was the first rise in 3 months. There's more than 125,000 jobs created since January. Job ads are at a 19-month high, and Chinese tourists for the year were a record 1,050,000. I knew I was going to stuff that up. And even retail is better than you think, with sales up 4.1%, marking the best 12-month rolling period since March 2010. Furthermore, New South Wales retail grew by 7.4%, the best rolling 12-month period since January 2002. There is good news out there, but our leaders need to start talking it up, and I need to have shorter comments as well. OK, guys, Paul Rickard is still with us, and we're joined by the AFR's hotshot writer, Christopher Joye, who has sounded some warnings about our banks and the surge in property prices. So, is he right about our banks? Are they less safe as an investment than many of us might have thought they were? Christopher, thanks for joining us. Sorry for having that long comment piece. I should have made
I never thought it was going to end.
I know. I thought maybe should have been half a minute shorter. But there's a lot of good stuff there, and I wanted to respond. Paul, I'm glad you're still here. Guy Debelle.
Yeah.
Now, I know how smart he is.
Yeah.
But it wasn't a smart thing.
Mate, it was really funny because I remember seeing the Bloomberg headlines that Debelle had given this speech warning of violent reactions in financial markets. The problem was we were already getting the violent reactions in financial markets, literally. I mean, equities had lost 10%, bond yields were plummeting, credit spreads were blowing out. So it was unhelpful. It definitely amplified, I think, the fear and paranoia. And financial markets are already good at oscillating between fear and greed. I don't think central bankers should be seeking to exacerbate that. I think the issue was that Guy wrote that speech probably a couple of weeks prior, if not a few weeks prior, when conditions were very benign and volatility was very, very low. And he was trying to warn people about the inevitable increase in interest rates and the normalisation in volatility in the future. So I think a more thoughtful approach would have been to say, hey, don't worry about these current ructions. It's actually all, as you were saying, it's all part of a good underlying news story, which is the US economy is recovering, interest rates in the future are expected to be higher, notwithstanding these occasional shocks with Ebola, China wobbles, Europe perhaps growing more slowly than people expected. Just quickly on Europe. Europe, or the EU, only contributes 10% to global GDP growth. So it's actually not that important, but people get completely consumed by these negative news stories.
Paul, what was your reaction to Guy's violent market reaction?
Well, I think the first thing that will be happening is the RBA will be restricting the word violent out of the lexicon. You don't use that word when you go to public. Look, he was talking to a group of market traders, for a start, and that's the first point. Secondly, he was talking about how markets have a habit of not overreacting, but, when sentiment changes, you've got to have buyers. And he was talking to a group of traders who were recounting experience back in the 1994 when the bond market here had a big change. And he really was talking about the same problem here when long interest rates want to go up. And because they're so low, they're sort of the lowest rates in 100+ years, no one quite knows what's going to happen because there may not just be the buyers out there ready. So he's trying to warn people that these things can change quickly. I agree with Chris. Timing was wrong. It was the wrong word to get used because the way it was headlined and things like the ABC was talking about the equity market. It's actually talking about the bond.
Our buddies really screwed. The share market headlines were like, it was bond market.
He was talking about the bond market rather than the equity market per se. So, I think... Don't use the word, but what he was warning is things can change. We've seen that over the last few weeks.
And of course, Chris, you have learned that a lot of our colleagues don't understand the difference between the share market and the bond market.
Well, that's true, actually. I saw a news headline that had to be corrected because people thought that bond prices were falling, when in fact, actually, bond prices were rising strongly. And the bond market actually proved in that episode to be a pretty good hedge against that equity volatility.
OK, let's talk about this because people don't understand the bond market, and Paul's alluded to it. There's going to be a time when the bond market's going to be under pressure. What do you think is going to happen? Is it going to be a scary moment? Because in 1994, I've checked it up, equities only lost about 11% over that period. So they went down, but it wasn't a massive thing, because people have to put their money somewhere.
Yeah, so people also mix up with bonds, hybrids, which we'll talk about later. But the key point to understand, I actually interviewed a guy that runs $8 billion here in Australia, a guy called Kumar, who you know. And we ran a big story in the Australian Financial Review on his views on this exact subject. And he was effectively arguing what I've said for the last year or two in the AFR, for what it's worth.
Have you ever been wrong, Chris?
Wait a second, let me finish. Let's just easy up. So basically, Kumar was saying that you can have bonds that are variable rate and bonds that are fixed rate. Just like with a savings account, you can have a variable rate cash account, which follows the RBA rate up and down, or you can have a long-term term deposit. And a fixed rate bond, which is typically 5 years, is like a 5-year term deposit with the interest rate being fixed. The problem is that if outside interest rates increase, so if the RBA raises rates inevitably in 2015-16 at some point, the price of that bond will fall to compensate new buyers with a higher yield. In contrast, a floating rate or variable rate bond will just have a higher interest rate, and there'll be no change in the price of that asset. So horses for courses. I think the key thing for folks to do is to invest in variable rate debt instruments, because nobody, and RBA research has proven this, nobody can forecast interest rate changes beyond 6 to 12 months. Nobody has a clue. And that's why, as Paul was saying, long-term interest rates over 3 or 10 years, the markets whip around. 1 minute here in Australia, a few weeks ago, we had a 3% 3-year government interest rate. Today, it's close to 2.5%, because the markets wouldn't, frankly, know their butt from their boobs when it comes to what's going to happen to interest rates over the next 3 years. And the research proves it out. They can't get it right beyond 6 months. So you're better to take that risk out of your portfolio and just have a floating rate bond and not worry about what interest rates are going to do in the future.
But Paul, a couple of years ago, there were people in the USA and Europe, they're still taking, 0.9% government bonds and all that sort of stuff. Now, as interest rates rise in the USA, it's likely some of those journal investors say, I'm going to get rid of this and try and get 3.5% in the USA. Is that going to cause an international financial problem?
I think that's what partly the guy was talking about, and I think the answer to the question is we don't really know. The question is, where does the money go? You've always got to come back to the problem. If you de-invest out of one asset class, you've got to put your money somewhere else. So there's so much money in government bonds. They are the safest investment, and the US Treasury can keep printing them, and does. And, it can put its money back on deposit with the Federal Reserve Bank and earn 0% interest rates or 0.01, or it can put into the equities market. So generally these things will find a level. So, I don't get worried about bond Armageddon. I don't think that's going to happen. But for me, I don't see a lot of value in investing in something very long at very low rates.
Okay,
I think I can do better also.
Yeah, and I think I can find a segue from that as well. That if there's going to be a bond problem, and it's two-part question.
Guaranteed it'll affect. If there's a bond problem, it will affect the equities
Well,
market.
Before we say anything, if there's going to be a bond problem, what that means, folks, is that interest rates are going to be increasing, which is good news.
My question. Yeah. But you're stealing my thunder on another point. If interest rates are going to go up, and there's a lot of our viewers will love that, but will our banks find it more expensive to borrow money overseas? And given the fact that you've pondered the lending of our banks, on some of your AFR columns, and the fact that hybrids rest on our belief that these banks are a really good investment, the bluest of blue chips. Is there a potential risk for our banks, not even to blow up, even just to look more risky, and therefore it could affect our investments? That's where I'm coming from. Chris, you have first shot of it.
Yeah, sure. So just quickly on the banks. The banks are pretty safe businesses. They're well managed. They've got tons of advantages. They've got government guarantees of their deposits, which is most of their funding. And in crises, the government has guaranteed their bonds. They can borrow from the RBA.
Which you criticise occasionally, but I love it.
Well, I just want them paying for all those guarantees. That's the key point. They can borrow from the RBA, which is unique. Not many businesses get to borrow from the government. They borrow from the RBA in an emergency at 2.9%, at 0.4% above the 2.5%.
I love insider advantage, but go on.
Yeah, but the key point is this. The four major banks hold, in dollar terms, about 4.7% of equity. And that means that they're funding every $100 of asset with, roughly speaking, $5 of equity and $95 worth of loans. So the key question for viewers is this. In a crisis, is that $5 of equity, which is being used to buy $100 worth of assets, which are all business and home loans, is that enough? Is it a big enough buffer? If we go back to 91, you'll see that it is enough, but a lot of that equity would have been destroyed. So ANZ and Westpac in particular almost went bust because they had losses equivalent to 30 to 40% of that equity. I think David Murray, the good news for folks is that David Murray, who's doing this review of the financial system, is going to recommend that equity buffer increases by 2 to 3 percentage points to 7 or 8%. And I think that's going to be more than enough to withstand most conceivable crises. So the banks are pretty safe. On the question
pretty safe. Why do you put...
Well, they're leveraged 21 times, mate. At the end of the day, that 4 or 5% buffer currently may not be enough.
At 7%, would you take the pretty out?
Yeah, no, I think they're very safe. And the truth is, I've had regulators say to me that we will not allow the four major banks to fail. So they are too big to fail. But just on the hybrids point...
Love those regulators.
No, I want to cut in, Chris. I think he's being a little bit too negative, and I don't think David's going to recommend that type of level.
By the way, he wasn't like that until he went in the media. Since he's been in the media for, he's gone more negative.
You've got to sell your story, don't you? Right. But look, there's the point. I mean, I think the difference, if I go back between 1991 and 2014, 1991 was about banks lending into businesses. It was largely commercial property. Okay, that's what caused Westpac and the ANZ and a few others to get differently. What we've seen in 2012, 13, 14, it's all housing. There really is almost negligible business credit growth out there. So, I mean, if you look at the bank statistics at the moment, there is no sign in their arrears, their 90-day pass book, any of their ratios of any problems occurring. So, if there is going to be a problem, I think it's some years out. So, look,
I agree with that.
There may be that as a result of David's inquiry, they may have to increase their capital marginally, but I think all the banks will tell you they've done a lot of stress testing. Until you start to see some pickup in business credit growth, I reckon they're as safe as houses.
Okay, good.
I'm going to maintain that
view. We talk about hybrids as well.
Yeah, we're going to hybrids in a second. So the bottom line is this, Paul. If David does push it up from 5 to 2, 5% to 7%, sorry, do you think that will affect the share price much, or do you think the safety aspect will actually increase the share price?
It depends how it's done over what time period. Look, his recommendation, first of all, the government's got to adopt it. So that's to number one, and the banks will come back to the government, whatever he says. And B, it'll depend on APRA, and I think there are some arguments about why it won't be adopted in the same, what he might say. So it depends on the time frame and how they do it. So, look, I wouldn't get too concerned about that. Let's see the recommendation first.
Chris, and I agree with Paul, partly. I mean, I think David will recommend a substantial increase in equity. It'll lower the expected returns that shareholders get by about 10%. But here's the rub. They will have a lower expected return, but they'll also have lower expected risk, right? So I personally don't think... It actually, I think there's an example in the US, Wells Fargo substantially improved its equity and lowered its funding costs, to your earlier question. So it'll be actually easier and cheaper for the major banks to raise money because there'll be less risky concerns and they'll look even better compared to their peers overseas.
Do you think it could be a share price positive to it?
I don't think immediately. I think immediately people will react negatively and say, oh man, bad news. Possibly, but I think in the medium term it definitely improves the stability and solvency and durability of the businesses, and I think it's actually a good thing for owners of the business because the business, I think, currently is carrying too much leverage. I think 21 times leverage is too much.
Okay, now I wanted to talk about hybrids in this first section. We're running out of time. I'm going to ask Paul to stay because you guys are agreeing too much. I want to at least have one fight before you go. So we'll come back after the break. We'll talk about hybrids and we'll also talk about macro-prudential controls. I'm presuming, Paul, you can say.
Yeah.
Good, fantastic. So we'll see you after the break.